Hey everyone, Ian King here, editor at Banyan Hill with your weekly market insights video. Before we get started on this week's video, I want you to please ask you to subscribe to our channel right here. Hit the subscribe button. If you like this video, you can also like it. And if you have anything to say about the video, please leave us a comment. With me this week, I've got Jeff Yasteen, my fellow colleague and editor of Total Wealth Insider. Jeff, how are you doing?
I'm doing really, really well. The market's doing well, so I'm doing well.
Sounds good. And I'm sure even if the market wasn't doing well, you'd be doing great anyway because you like to buy on dips, right?
That's right. You know, and if as you know, if you're going to invest in the markets, yes, you're aware of bull phases and bear phases, but more than anything, you're looking for opportunities, and that's that is where your system comes from. So yeah, we're always, and I'm always looking for opportunities.
So something on everyone's mind this week is going to be Netflix's earnings. And, they are the largest streaming service in the world. They're spending $15 billion a year on content. There's a lot of competition out there. We're seeing Apple and Disney and, of course, Amazon Prime spending $6 billion each of them per year on new content. What do you make of these Netflix earnings that are coming up very shortly here?
I think, Ian, the key is probably less about the actual reported profits, and it's really, I think, about Netflix's subscriber growth and whether it managed to get any through the fourth quarter of the year, because it seems like that's where the story is evolving to for Netflix, and has for some time. Is they've had enormous subscriber growth, and I think they're at like 60 million or so, but they've been flat for basically all of 2019, and I think that's going to be the key. Is, are they flat again for the fourth quarter, or did they decline perhaps with Disney Plus being unveiled by the Disney company during that period? And I think that's what's really going to drive the narrative, because obviously if they can't keep up subscriber growth, I think that's going to affect the earnings outlook for them as well going forward. I mean, what do you think?
That brings up a great point, because if you look at subscription services, I mean, let's face it, there are all these competitors to Netflix, but you're not going to cancel Netflix because you want to have Disney just instead. You're going to have all the streaming services. I mean, in my house, we've got 5 or 6 of them. I can't even keep track anymore. But Netflix has 24 Oscar nominations this year. I mean, there are better movies on Netflix than there are in the theaters in some cases. So it's really hard to make the case that more competition is bad. I mean, I think the cost of content will probably increase, which means their margins are going to shrink in the next few years, but because you have all these services competing for the same shows. But realistically, I mean, Netflix under $10 a month, are you really going to cut your Netflix subscription because of Disney Plus or Apple? I just don't see investors and viewers really taking that step.
Well, let me take the other side of it here, because the one thing that worries me, like Netflix, great service, great company. Obviously, it's been a great stock for a number of years, although it's basically been going sideways for the last year to 18 months or so. The thing that worries me about Netflix is the amount of debt that they're piling on to basically acquire these, the properties and the top talent in Hollywood to get these Oscar nominations. Because I'm sorry, I have to look at my notes here, but in the last basically since 2016, their debt's gone from like $3 billion to $6.5 billion to $10 billion to like $12.5 billion as of the end of the third quarter of last year. And so it just worries me when I see them piling on the debt. Yes, they can handle it as long as their subscriber growth continues, but I do worry that if Disney keeps going, and depending on the demographics of the millennials, which are really helping and have helped to drive Netflix to where it is, if they're moving into more of a family building phase, or if we get a recession at some point down the road, then people start looking, well, do I need all these subscriptions? And as you say, then it becomes like, all right, do I stay with Netflix? And maybe they do, but then again, maybe they don't. So I'm just a little bit worried about that at this price level, with the stock being where it is, and basically it's trading at about 100 times earnings, and in a growth phase, I'd say that's great. But at a point like this where the subscriber growth has flattened out, I do think it raises some questions. And I wouldn't be a buyer of the stock, but obviously I think you disagree with me.
Well, I looked at the total enterprise value over EBITDA, and that ratio is the lowest it's been in 5 years. So even though the stock is increasing, the company is adding on more debt, they're also growing revenues and growing EBITDA every year. So they've got that going for it. You're right, at 100 times, it's pricey, but you're looking at something that is expected to quadruple revenues in the next few years. So it's still a growing company. But it's funny that you bring up what is going to get cut first, Disney or Netflix. So I guess parents in the next recession are going to have to decide, do they cut their children's viewing channel, or are they forced to cut their own consumption of Netflix? My guess it's people cut their cable before they actually cut their Netflix and their streaming services and just switch to. Another one of our big 5G plays is the idea that you'll be able to stream a 5G signal right into your house and be able to stream all your services with a higher grade signal than you're getting from cable. So it'll be interesting to see how that aspect also plays into these streaming wars in the future. But I really want to move on here because we had a big signing last week, obviously with the phase 1 of the trade deal. And I know there was a big signing ceremony in the White House. And there were some preconditions that have been criticized, whether or not they'll come to fruition. What do you think this trade deal does for the markets that we finally see it? Are we going to see a sell the news scenario, or are we just going to focus on maybe that carrot down the road, that phase 2, where we might have more of structural progress for our economy than this kind of superficial phase 1 trade deal? What do you think?
I have no doubt that we'll probably see some knee-jerk selling in the overall market once this deal is signed. It's just the usual thing, like you've talked about many times. Buy the rumor, sell the news. When they sign the deal, that's when it's old news. My view, though, I believe that really from this point onward, the market will likely continue to then focus on phase 2. Because, like my wife was asking me this morning, and we're watching the news, and somebody mentioned about this phase 1 signing, and she said, what does that mean? And I said, I don't really see that it means anything, because, whatever tariffs are in place, they're still in place after this phase 1 deal. The administration said that. So, the market, in my view, already sort of reflects that. And therefore, as long as people feel like the economy is continuing to grow, despite all the concerns about higher valuations and other things like that, that are a reflection of the market being at the pace and the height that it is now, I think it's possible that the market will just continue to look then to phase 2 with perhaps the anticipation that it's signed, sometime, late this summer or something like that. And the market will just move up again, in anticipation of that. I mean, what do you think?
I mean, I've said this all along. I appreciate and I like your points, but China is not the China of 10 years ago. They don't rely on exports as much as they did, which is why they were able to hold off as long as they were. And I just don't see this being a huge structural thing. I mean, if you look at the U.S. economy, we already have unemployment at 3.2%. So where are all these jobs that we need to bring back to the U.S. going to happen? And you and I have discussed this. If we get an increase in manufacturing in the US over the next decade, it's all going to be automation. We're going to have robotics. We're going to have self-driving trucks moving goods around the country. I mean, I just don't see this being a huge structural windfall for the American worker any more than maybe investing in education would be, or to some type of skills training to get more people into the modern economy. So I just think this whole trade war is really just something, a thing of the past more than what we need to deal with right now. But, the market always likes to hear good news or pretend that there's bad news on the horizon that's going to be solved. The reality is, if rates stay low this year, if the Fed is on hold, and it looks like they probably are going to be, stocks are going to perform better than expected.
Yeah. And you raise a good point, Ian, also in that and it's something for all of us as investors to think about here. Quite often we see the market go up or go down, and then we want to attach a reason for it. We attach that narrative to explain it, even though that explanation may not hold water, as you were saying regarding this China situation. I think of it a little differently. Yes, China isn't as important to the U.S. economy as it once was, but I do feel like the market wants certainty on this issue, if only because of things like agriculture and other key aspects that are important, as well as like airplane production, things like that, that are important exports from this country into China. But the market's come this far, carrying this weight, whatever weight it is, behind it with the tariffs. And unless we get some sort of giant sell-off, which will probably be bought anyway, I just don't see. I don't see the market being affected by it. It'll just look forward to phase 2 and hopefully a resolution of that.
Yeah, I agree with that as well. And also, one thing I note that I came across this week is that I heard Larry Kudlow was talking about a potential infrastructure plan for the U.S. economy in 2020. And I mean, I just say, look out to all the bears if there is some type of infrastructure progress, because that's something that, the Trump administration has been talking since the inauguration.
Yeah.
And it's something that the Democrats actually could side with him on, because they want, to create a better infrastructure in the U.S. And there are plenty of stocks, I know I've got them in my portfolios, I'm sure you do too, that would really benefit from more infrastructure spending in the U.S. and also would goose our economy, of course. But
yeah, and that's a really good point, Ian. And the other thing about an infrastructure deal, should it come to pass, because it's been talked about in some form or another for probably the last four administrations. But should it come to pass, that might be the one thing that the U.S. economy, as well as the global economy, would need to go from this sort of deflationary mindset that we've had, and we really saw the worst of it, in my view, in the last 5 years or so, to a point where we get to that inflationary mindset, which tends to creep up on things. But if you're talking about huge amounts of construction, then you're talking about resources that can't be expanded very quickly in terms of mines for sand and concrete plants and steel and those sorts of things. And so that could flip the whole narrative. And in some ways, that'd be a good thing for the rest of the world as well, because again, we put the deflationary scenario behind us and it becomes an inflationary scenario, which is good, at least until the bond market begins to sniff it out and we start getting higher interest rates at some point down the road. But it's a little early to be talking about
I mean, we have plenty of room to wiggle in the bond market. It's $11 trillion of global debt is trading at a negative interest rate. So for them to actually go positive, I think that would be a good thing, because like you were saying, it would show that there was demand for resources, demand for commodities,
yes.
and growth was ticking up again. So let's hope that would happen.
So Ian, one reflection of this sort of deflationary scenario that we've in the U.S. economy and global economy has faced over the last number of years is negative interest rates, which they see certainly in Europe. That has helped drive things like Bitcoin as this sort of safety speculative play. Bitcoin's come back quite a bit here in the last number of months, the last year or so. What's your view for crypto, since you're for Bitcoin, since you're our crypto expert?
It's really been a sneak rally. It kind of was one of those things where we had this big mania in 2017 where everyone loved the crypto markets. And then we had a sell off in 2018, which brought Bitcoin prices down to 85%. Then we had a recovery in 2019. And from the lows of 2018 to the highs, which happened in June 2019, Bitcoin increased by over 4 times. Okay, so you went from a $3,100 price of Bitcoin all the way up to $13,000. It's pulled back since then, but it still was the best performing asset in 2019, up 87%, and really no one seems to be talking about it.
How do we know that performance that we saw last year is a reflection of the increasing use of cryptocurrencies and things like that and for blockchain technology, et cetera. How do we know it's that and not just a reflection of the speculative fever environment that we see certainly in the stock market these days?
Sure. I mean, the space is always very narrative driven. And there has kind of been this thinking that the millennials, when they want to think about a safe asset or a place to park their money, instead of buying gold, they'll buy Bitcoin. And if you look at surveys of millennials, their preference for Bitcoin is much higher than it is for gold as a store of value. So that's one aspect. The second aspect is we do have a lot of geopolitical tension right now, whether it is what's going on in the Middle East or the US-China phase one trade war, and also, as you mentioned, negative interest rates in Europe, where you put your money in the bank, you buy a German government bond, you're actually losing money over 10 years. So people are looking for this safety, this safe asset, this currency that is not correlated with their own home currency, that can store value for them over time. Now, there's that aspect, and then there's the other aspect of that, the infrastructure underneath Bitcoin, the ways you can buy it, the ways you can custody it, has greatly improved in the last 2 years, specifically for institutions. So we have Fidelity has a custody solution for institutions. That's a big thing. You've got the Backed Futures Exchange, which opened up in late 2019. And what this futures exchange allows for the first time is actually physical settlement of Bitcoin. And it means that if you have a futures contract and you hold it at expiration, someone is going to deliver you Bitcoin at the end of the contract expiration. That's how futures contracts should work. The other previous iterations of the futures contract didn't have this physical settlement. And this is a big thing for institutions looking to hedge their physical Bitcoin risk. We're also seeing a proliferation of different option markets surrounding Bitcoin. So you're seeing kind of an advancement or an evolution in the financial industry underneath Bitcoin and making it a real asset class that institutions are interested in putting as part of their portfolio. And one other aspect of this, it is still about 1/50th the size of gold's market cap. It's tiny if you think about it. If it gets to 10th of gold's market cap, you're looking at another 5x return from here. Could be 50,000 in the next couple of years, just based on that expectation or that forecast.
Yeah, and it's certainly caught the attention of everybody who wants to speculate. And like I said, it's something you can speculate in and do it in a way that's in many ways more liquid than what you can see with certainly physical gold. And I like what you're saying earlier as far as institutions, and that certainly happened, in the time that I've been alive, like interest rates used to be, more or less fixed. And then in the 70s, as they become less fixed, and you saw some of the first institutional moves for the futures exchanges and trading interest rate-based futures contracts, and certainly with Bitcoin going in that same direction, it just shows there's a market for it. If institutions are getting involved in it, it's going to be here for a long time to come.
Absolutely. One other thing I'd like to add, because maybe your son has told you about this, but this week the NBA gave clearance to a Brooklyn Nets guard, Spencer Dinwiddie, to actually tokenize his NBA contract. So he is selling fractional shares of his NBA contract to the public, or to accredited investors really, that want to participate in his performance. And he's paying an interest rate about 4.5%. So basically the way these NBA contracts work out is you get paid in a lump sum at the end of the year. What this NBA player is doing is getting that lump sum up front from investors and paying them in interest rates. And he's replacing this kind of, it's considered sort of like a payday loan, but for high net worth celebrities and famous superstars, where they know the money's coming in at the end of the contract is guaranteed. We know that the NBA is going to fulfill the end of the obligation. So he's tokenizing it really to get the money up front. And I think it's really interesting because it opens up this whole new world of being able to tokenize your future value or your future earning stream. And if you think about how like Instagram influencers and social media influencers have been really decentralized, it allows people to basically participate in their growth. So if you're an Instagram influencer, and you've got 50,000 followers, I see this path where you can sell a share of your business, of your franchise, of your brand to your devout followers. And as you start gaining contracts from, sponsorships, whether, if you're in the beauty industry, it could be a sponsorship from a makeup company. And so it's enabling this whole new world of finance that nobody even thought existed 10, 15 years ago. And this is what blockchain is doing. And it's pretty amazing. I think that's why people are becoming more interested suddenly in the entire crypto space.
See, that's fascinating. I didn't know about that. My son hadn't told me about it yet. And to me, it points to the sort of thing where, if you're of a certain age, you look at it and say like, oh, come on. But at the same time, you have to realize, for anybody who's saying that to themselves, you have to realize this is where new businesses and new business models come from. In the same way, 20 years ago, 25 years ago, Amazon, came public, and it's like they sell books. Well, big deal. But suddenly the whole idea of this platform, the platform business, basically a brand new concept for, at least for the internet age. And then we have, social media and these other new businesses that have come along that probably didn't make sense to a lot of people when they were coming out. Again, if you're thinking in old ways, and what you're talking about is a new way, and it's the kind of thing that is going to create a whole other range of businesses, as you were just saying, looking out 5 years, 10 years, and 20 years down the road. It's incredible. Thanks for telling me about that.
Anytime, Jeff. I'm happy to share everything about what I come across in the crypto markets with you and our viewers. So that really brings us to the end of this week's Market Insights. I want to thank everyone for tuning in, for myself and Jeff Yasteen. If you like our video, like I said, give us a like button down there. Tell your friends about it. If you like what we have to say, maybe you want to comment or have a question, please reach out to us in the comments. We'll be sure to get back to you. Thanks again, everyone, and have a great week. Take care.